A commodity that was once trading at $140 suddenly became so worthless that you couldn't even sell it for free. On the 20th of April, oil prices crossed the $0 mark and went as far as -40. Some people got excited since they were expecting free gas at the gas stations. Some went as far as imagining that they will be paid to buy the oil, which sounds a bit strange. To understand the current crisis, we'll have to have some clarity on how crude oil prices work in the first place. Like any other market, you would assume that the laws of supply and demand would drive the price. Oil producers on one side, such as Saudi Arabia, Russia, UAE, and others, and a dozen major consumers on the other side, such as the US, China, and India. So if suddenly these countries would no longer want the oil, the prices would decrease, and vice versa, of course. Oil producers can also manipulate the price based on how much oil they would supply the market. But here is the problem with the oil market. Sometimes the demand rises, but the price drops, which doesn't make sense using the laws of economics. And that is because oil prices do not often work with supply and demand, but are more driven by what happens in the financial market. Yes, those dudes in the Wall Street with fancy suits quite often have more influence over the oil prices than oil producers themselves. This industry is really competitive, and it's not easy to get into it. You can't simply drill oil under your house and start selling it. It's mostly governments or government-controlled companies who are producing the crude oil, and risks are high, like really high. Imagine spending millions of dollars extracting crude oil from your soil, then ship it to your client who is thousands of miles away, and then find out that oil prices have dropped. In fact, they dropped so low that selling this oil is just unprofitable, or worst, you have to sell it at a loss. To prevent such things from happening and be confident that, regardless of what happens, the buyer will buy your crude oil at an agreed price, you make a contract. Let's call it a forward contract, where both of you agree to buy and sell a particular asset, in this case crude oil, at a specific price on a specific date. Whether the price of oil increases or decreases, it doesn't matter. The seller has an obligation to sell the oil at an agreed price, and the buyer has to buy it at that agreed price. But on the other side of the spectrum, there are speculators. These are the rich dudes from Wall Street who are trying to make money by speculating on the prices by buying and selling futures. A future is a contract pretty much like a forward contract, except it's often not delivered, and it's traded in the market like a stock, and based on what's happening in the oil industry, the price of the future changes. Let's say Mark is a trader and wants to speculate on the prices of crude oil by entering into a future contract in April with expectations that the price will be higher by September. The September crude oil future contract is trading at $40 right now in April, and Mark buys that future. The contract is worth $40,000 since oil traded in blocks of 1,000 barrels. Fast forward a few months and it's September, and the end of the contract is approaching. Lucky for Mark, the price of the oil has increased to $52, so the future contract he purchased for $40,000 now worth $52,000. So he sells the contract at that price and makes $12,000 in profit. But if the price had fallen to $35, for example, he would have made a loss of $5,000. Simple, right? But from April to September, the price of the oil fluctuates, so does the price of this future, and Mark can sell it at any point. Futures allow investors to use leverage to trade with oil without physically dealing with it. Let's say oil prices are $20 and you're expecting them to increase next month. Such a contract worth $20,000. But you can buy such a future for as little as $1,000 and leverage the rest. The price goes up to $25 next month and you sell the future for that price, $25,000. You still owe your broker $19,000 since you only paid $1,000 for this contract, and you're left with your $1,000 and $5,000 in profit. You have profited from crude oil without producing it or buying it. So, back in 2001 and 2002, many of these traders speculated that the price of crude oil would rise since countries like China and India were growing exponentially. They would need more oil to keep growing, so the demand for oil would increase. Therefore, oil prices kept growing until they reached $140 right before the 2008. And crashed together with the rest of the economy, as everyone expected the demand for oil would fall since there is a financial crisis in the streets. And since then, they haven't really grown that much since renewable energy is getting more and more popular and a wide range of other factors. But that does not mean that oil is getting worthless. At least in the next few decades, oil will still be the major source of energy, because it's not only used to fuel your car and plane, but in almost everything else we use day to day. If that's the case, then how did we end up with negative oil prices? First of all, we had a price war between Russia and OPEC countries. OPEC is an oil cartel that consists of 12 major oil producers, but Russia isn't part of it. However, in recent years, Russia decided that it would be better off if it would collaborate with OPEC. But then in March, Russia decided that it won't need OPEC anymore and would be better off on their own. So the de facto leader of OPEC, Saudi Arabia, decided to punish Russia for violating the agreement by flooding the market with so much oil that prices dropped by half. Traders and speculators were already afraid that oil prices would decrease further and placed future contracts at a lower price. And then the pandemic struck the entire planet. The United States and other major consumers of crude oil had to go on lockdown. So with so much oil in the market and with no one to buy it, of course the price significantly dropped. Especially future contracts, since their price changed daily based on what's happening in the industry. But what was interesting is what was happening with futures of WTI, or West Texas Intermediate. Their last day of trading crude oil future contracts was 21st of April 2020, which means all the oil traded under this contract is set to be physically delivered next month, which is May. But the country is on a lockdown, and the demand for fuel is below the ground since there aren't any cars in the streets and planes are grounded and parked at airports. In other words, a ship full of oil will be delivered, but there is nowhere to store it because the United States has seen its oil storage capacity fill up. After all, airlines and other buyers aren't using nearly as much crude oil as they were before the crisis. So if the firms with the ability to store it aren't buying it, you still gotta do something with it. You can't simply throw it away or ditch it in the ocean. So the owners of these futures wanted to get rid of these contracts by selling them as soon as possible, because as mentioned before, they have nowhere to store that oil. And since no one was willing to buy these contracts, the owners of these futures paid the buyers who have the capacity to store that oil to take it off their hands so that they can exit the markets. The oil isn't sold for free or at a negative price. No one would spend millions of dollars to extract the oil and then end up selling it for free, but rather only the demand for futures in this financial market dropped so significantly that the owners of these contracts had to pay the buyers to take off the burden of storing the oil from their shoulders. In fact, the negative price has scared off investors so much that the price had recovered the next day. The futures for the next few months are already higher, reaching even $30 per barrel. Of course, futures and forwards are a bit more complicated than what we have explored in this video, but in the middle of so much misinformation, I wanted to provide some clarity on what exactly negative oil prices mean. And I apologize that this video isn't on time. The problem with our videos is that they take a lot of research and are animated by a different person, so the video can take some time before it's ready to be uploaded. In anyways, if you have enjoyed this video and found it helpful, please give this video a thumbs up and let me know in the comments about what do you think about all of this. And of course, if you're new around here, then hit the subscribe button and the bell besides it. Thanks for watching, and until next time.